Japan, once the second largest economy in the world, has been stagnating with no real growth since its prime. To combat this, Japan implemented unprecedented economic measures, such as high rates and consistent deficit spending. However, none of these measures have worked. This has led some economists to question whether Japan's economy is causing this stagnation or if the world is not sustainable for any economy. Japan has been ahead of the curve in economic stagnation, inflation, and government policies over the past 3 decades. The modern economy of Japan has fully recovered from the impacts of World War II and has rebuilt itself through free trade, focusing on resource-quality manufacturing and relying on other nations for raw materials, food, and produce. However, Japan's domestic manufacturing is starting to outcompete countries like West Germany and Japan, particularly in the auto industry. In 1985, the 5 participating countries signed the Plaza Record Plan to artificially lower the value of the American dollar relative to Japan. This plan aimed to make American manufacturers more competitive globally and domestically. However, Japan, heavily dependent on exports, did not agree to this deal, as lobbying from American manufacturers would have forced the U.S. government into imposing trade tariffs on Japanese imports. This would have been worse for Japan, as it relied on America for cheap cars and home theater systems. The Plaza Record was seen as a win-win for both countries, as America gained more competitive manufacturing and Japan received cheaper goods. However, the relative value of Japanese people's money more than doubled in the late 1980s, leading to a boom in real estate and city centers. Japan's central bank reduced interest rates to reduce the impact of lost exports, but this money was mostly used to speculate on the stock market and real estate. In Japan, businesses faced a similar issue as people had seen their net worth evaporate due to crippling debts. Consumer spending fell as demand for goods fell, leading to deflation and reduced prices. The Japanese central bank tried to combat this by lowering interest rates in the 1990s and 2000s. However, Japan faced new downward pressure in the 2000s, as it realized its young productive population was no longer contributing to the economy. The aging population is not unique to Japan, as most advanced countries have birth rates below 2 children per female. Japan's central bank used quantitative easing, creating money and using it to buy up assets in the open market, such as government bonds, corporate bonds, and shares. This strategy put money directly into the hands of those selling these assets, allowing them to spend on infrastructure, social programs, and investments. Despite low interest rates and quantitative easing, inflation in Japan has remained low, hovering around 0%. Japan's economic situation may differ from other countries due to the US's heavy quantitative easing over the past 2 years, the aging population, and the elasticity of demand for bread. The productive capacity of Japan today is not significantly different from 3 decades ago, and the culture of Japan is more difficult for economists to grapple with. Japan's culture is taboo, and the aging workforce makes it difficult for companies to raise disposable incomes and promotions. This has led to increased personal income and disposable income. Japanese consumers are cost-conscious and demand stable prices, while companies have historically preferred to give back to investors. This can lead to inflation if people expect price increases and content with stagnant wages. Japan's economy is complex and can be a great example of money inflation. While it has a GDP of just over $5 trillion, it still falls behind places like the US, Germany, and Australia. Please like the video and subscribe the channel for more updates.